Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring. Today is Saturday, April 30th, 2022. We're in the weekend, and today's podcast, what we're going to do, we're going to take a look back at last week's action in the stock market. We're going to talk about the trades I took, when I took them, why I took them, how I'm going to manage them going forward. It was a crazy week last week. Really out of this world down market, and it's been scary. I know a lot of people who are scared. It's been a challenging week, so my heart goes out to everyone out there that's trading. Been very difficult to swing trade, but I mentioned this last week. The lower we go, the way that I look at it, the better opportunity that we have to buy some stocks at some good levels, look for a bounce. The stock market goes up and down. I mean, go back through your charts. Does it ever go straight down and never come back? No, it comes back. Does it ever go straight up and then not come back down? No, the market goes up and down. That's what it does. Last week seemed like it was only one way, which it was, except for Thursday. But listen, we're coming into some levels on some interesting stocks here. So I think there could be some good opportunity there. So I hope you're staying careful. It is vicious. It is brutal. But this too shall pass. And so after we take a look at my current positions, what we're going to do, we're going to talk a little bit about trader psychology, very appropriate time. You know, when the market comes down, emotions get amplified. Mine certainly did last week. I can tell you that. I be right up front with that. But that's how it goes sometimes. We have good weeks. We have bad weeks. We have to take a look at the big picture. But trader psychology right now is probably more important than any time because, you know, when we're in an uptrend, you've been there. When we've have uptrends, you never feel like you can lose another penny again. Well, you can. And right now it feels like we can never make another penny to the upside, but we will. I promise you we will. But in the meantime, we have to keep our emotions stable. We have to follow our plan. We have to follow our process. We have to position size very carefully right now. It's a huge thing, position sizing, because you need to position size based upon the market's current volatility. If the market is at an average volatility, let's just call an average volatility 1, and you buy 300 shares, fine. But if it increases to 2, if the volatility increases to twice, to double, the 300 shares that you are buying, really like buying 600 shares because the volatility has increased twice, and now it's probably increased 3 times. So you'd have to position size even smaller. So, I talk about this all the time, the importance of position sizing based upon volatility. What I do, I take whatever my account value is, let's just say it's $100,000. Usually a good rule of thumb is 1% of your capital. That would be $1,000 divided by the value of the 2 ATR. And that will tell you how many shares to buy. And that does all the work for you. It factors in all the market's volatility over the last 20 days. And so I'm a big, huge proponent of position sizing based upon volatility. When volatility is higher, I buy fewer shares. When volatility is lower, I buy more shares. And using the 2 ATR to position size to tell you how many shares to buy is one of the best ways I have ever found. Me personally, I don't use 1%. I use 0.5%. I just like to be a little bit more conservative with my swing trades, but 1% is kind of a well-known good rule of thumb. If you have a larger count, or if you're more conservative, you might just want to take a look at 0.5%. I know people that use 2%, 3%. Of course, there's pluses and minuses to it all. But I have something I think that's appropriate in the trader psychology section today that I posted on Twitter, got a lot of feedback on, so I think people liked it. So I'm going to cover that as well in trader psychology. After that, I do have a poem from my good friend Frank, the trading poet. He always writes poems that are apropos of what's and relevant of what's going on in the market. So I'm going to share that one with you as well. And then after that, I have already gone down through my watch list. I have checked looks like 17 different symbols of stocks that I'll be looking at next week, looking for different levels either to the upside or to the downside that I might be interested in taking. All right, so first of all, we're going to take a look at my current open positions, talk about when I bought them, why I bought them, how I am going to manage them going forward. I also have some closed positions that I will go over as well. Trader psychology, trading poem from Frank, and then we'll take a look through the watch list of the ones, the stocks that I marked and that I'm interested in for next week. So that's the plan. So before we get started, I do have to run the U.S. legal disclaimer. It takes about 40 seconds. So hang in there for about 40 seconds and then I'll be back and we'll get started. Thank you. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much. All right, let's get started, everyone. Here we go. First open trade that I have is Pfizer. I did buy Pfizer on January, February, March, April 25th, 2022. Why did I buy it? Well, I bought it back here again, April 25th. I had a close under, close back over the 200-day moving average. That was my support level. In addition to the close under and then close back over the 200, I also had a V1 entry signal. V1 consists of two bars. Bar 1, bar 2 has to go under bar 1 by at least a quarter ATR and then close above the close. This is probably a good time to put in to make this point, but I like to buy swings that have the most combination confluence of indicators possible. Yes, an under 200, over 200 is legitimate on Pfizer. It does back test, but I like to put the odds in my favor even more by looking for other signals as well. What's another signal here? Well, the V1. Like I said, bar 1, bar 2. Bar 2 goes under bar 1 by a quarter ATR, washes it out, closes back above, in addition to the close under and back over the 200-day moving average. Those are combinations of signals. In addition, we also rejected the negative third ATR channel. That's this line here. This is 3 standard deviations away from the mean. 92% of prices tend to hold here, stop going down, or go up. So you'll increase the ability and you'll increase your chances of having a profitable trade if you look for as many different confluences, combinations of indicators lining up. And why does that help? Well, each indicator, like the under 200, over 200, that's going to bring in certain buyers, just that by itself. The V1 entry signal is going to also bring in buyers. The rejection of the negative third ATR channel and close back above will also bring in buyers. So it just brings in more buyers, and the more buyers that you have, the more likely you are to go up if you are long. So that is why it's very important to look for confluences, combinations of indicators. So when I looked to buy this, I was talking about the 2 ATR. Again, let's just say I have a $100,000 account. 1% of that, $1,000, right? I guess we'll just go with what I do. I'm about 0.5%. Okay, not about. I am 0.5%. I don't want to say half or about, but I am 0.5%. So, if I have a $100,000 theoretical account, 1%, it's $1,000. Half of that is $500. So I would take $500, I would divide it by the value of the 2 ATR, and that accounts for the volatility, for the increased volatility. It has me buy fewer shares. So V1, close under, close back over the 200-day moving average. I place my emergency stop down here, 2 ATRs from my entry. My end of day stop was a close under the 200-day moving average. So it has not yet closed back under the 200-day moving average. I have the orange line up here. That is my trailing stop level. Once I move 1.5 ATRs above my entry, I go into a different trailing stop mode. We have not got there. You can see we got close, but we have not got there. So when I create a trade, I look for the entry, I position size based upon the market's current volatility using the 2 ATR. I place my emergency stop. I have my end of day stop, any close below the 200, and then I have my trailing stop level. In addition to that, if the price moves at least 0.45 ATRs from the previous day's close, I will take a portion of the profits as it moves up. And this is exactly what happened on the next day after I bought it. I bought it here at 49.01. Next day moved up, did hit a profit target, 10%. I did hit one profit target, so I took 10% of my position off. Next day came back down, intraday went below the 200 and then reversed back above. I base everything on closing prices, and so I held the stock. Next day it moved up even higher. I hit another profit target, and then on Friday with the big move down, I had 20% fewer shares because I got out of some here at the first profit target. I got out of some here with another profit target. So I took 20% off at profitable levels. Let's see, where did I buy? 49.01, it's 49.08. So it is up on the trade, the remaining balance up on the trade. But more importantly, it definitely is up on the trade because I took off 20% of the position at profitable levels. Now, next week, if it closes below the 200-day moving average, what am I going to do? That's my end of day stop. So I'll just go ahead. If it closes below the 200, get out, follow my rules. And again, I have emergency stop down here. This is the only stop that I do not wait till the end of the day. If it ever gets down there, I'm just going to go ahead and get out. So, in this podcast, I try to cover what I do, how I look at things, how I position size, emergency stops, all that kind of stuff. And I hope this is helpful. I do teach private one-on-one lessons in the evening in the evening time via Skype. I have a 15-hour course. I think the best way to learn anything is one-on-one. I trade 5 different trading approaches, and I teach you step by step how to do everything. So the purpose of this podcast is just to kind of give you an idea of how I trade and what I'm doing. But if you really want to learn the details, you really want to learn how to do this, just contact me. Emails in the link of this description. And I've never had anyone that's taken the course that wasn't happy. I can promise you that. All right. So going forward, what am I going to do? Well, again, if it closes below the 200-day moving average, that will be my end of day stop. I will just get out. If it continues to move up, I'll just continue to take profit targets. If it gets to my trailing stop level, then I'll go into a different mode. And then we also have earnings here coming out on the 3rd. I never hold through earnings. It's just a rule that I use. As a trader, our number one responsibility is to manage the money we have, not to make money, right? Sounds weird. I'm like, hey, I'm in this to make money. Well, ironically, if you manage your risk, if you focus on keeping your losses small, the money will come. But if you focus on only making money and disregard risk, then you are in trouble. And one of the best ways to do that, and by that I mean put yourself in front of a freight train, is to hold through earnings. Yes, it can go up quickly after earnings, of course, but it can go down quickly, and we have to focus on that. That's the most important thing, is reducing risk, and holding through earnings is a great way to increase your risk dramatically. And so regardless of what this trade does, if I'm still in it, I will get out prior to earnings. And you'll see a couple other stocks that I did that with as well. So Pfizer, fine. Barely profitable, but profitable, holding in pretty nice considering the down move and carnage in the market. So again, end of day stops, 200-day moving average. If I have a close, if I still have the stock by the time it gets to earnings, I will go ahead and get out. Okay. Next one on board, TLT. All right, I did buy TLT back here on the 21st of April. What was the entry signal? The entry signal was a under 30, over 30 intraday. It went under 30, then back over 30, right? I position size using the 2 ATR. I placed my emergency stop. I placed my 1.5 trailing stop level above. So if it gets there, I go into trailing stop mode. So the reason for the trade was an under 30, over 30 intraday. So my exit on this trade will be a close under the 30 RSI. Right now you can see it's 33.24, still holding that the 30 RSI level. Purple line down here, what is that? That's my emergency stop. If it gets down there, then I hit my maximum allowed stop that I'm allowing myself to take on a trade, right? So bought here at 120.61, moved up actually pretty nice. The next day was down, but then we gapped up. I took some profits off again. I hit some intraday profit targets that were above my entry point. So if the stock or if the TLT here moves back down, at least I took some off at profitable levels. Right now it's not profitable level because I bought it at 120.61. It's 119.45. But I hope you can understand that taking off some of the position, a part of the position at profitable levels helps mitigate my risk to the downside. So it is holding the 30 RSI. It is holding the emergency stop. Currently, stock is this particular symbol. It's down less than 1%, 0.96%, but all in all, the total trade is not down 0.96% because I took profits off at profitable levels. So that's the plan with TLT. It's either going to close below the 30 RSI, in which case I'm going to get out. It's either going to hit my emergency stop, in this case I'll get out, or it's going to continue up and I'll continue to take profit targets from there. All right, so those are the only two swing trades on the daily. You know, I like to trade multiple time frames. I like to trade I trade all day long intraday. I trade daily trades. I trade weekly trades. I trade monthly trades. I do have a monthly trade that I'm going to show you that I exited. Don't have any weekly trades. Didn't take any new weekly trades on Friday. I always take weekly trades on Friday because that's when the bar closes. But last week, you know, with this market being down, it got me out of all of my weekly trades and I didn't add any more. Okay, so these are also daily trades, but these are stocks that I got out of. These are already closed out positions. I did buy Google, Googl, bought that on the 22nd of April at 2403.13. It went under 30 and then closed back above 30. That was my entry. So I got in at 2403.13. Next day, bounced nicely, took some profits off with my intraday profit targets. Glad I did that. Next day, came back down, closed below my entry point. Now here, it didn't close below the 30 RSI. So you might be asking yourself, well, it didn't close below the 30 RSI. Why did you get out? Well, I got out because of earnings. Earnings were after the bell that day. I just mentioned I'm not going to hold through earnings. And on this particular swing, good thing I didn't. So it ended up to be a loss, 1.07% loss. Not quite that because I took two profit targets off here the very next days, but for 80% of the trade, it was a 1.07% loss because I got out for earnings at 23.73.65, and then earnings came out, and I'm sure, as you well know, Google just boom went down. And so it was good that I got out of the shares on that swing position. Then we had a huge rally back up and I thought, oh, shoot. And then Friday, way back down again. So this is a closed trade, got out because of earnings for a 1.07% loss. Okay, next up is gold. Well, this is an interesting one. This one really points out how important it is to have good trailing stop protocols in place. I did buy gold back on the 8th of April when we had this nice 520 crossover that happened in the value zone, that happened after sideways motion. Bought here at 181.45. Put my 3 profit targets the next day. I believe I hit 2, so I took 20% off there. Next day, hit another profit target, which was fantastic. And then we did get up here to the 1.5 ATR trailing stop level. Whenever a stock gets to my trailing stop level, if I then have a close below a previous day's bar, I get out of half the position. So 520 crossover, after sideways motion in the value zone is where I bought 181.45, took 2 profit targets off here, took another profit target off here. So that's 30% of my position gone. Got to my trailing stop level, and then the next bar closed under the previous day's low, and I locked in half profit on the remaining shares that I had at 181. at 184.14. Next day had a big gap up, took some more profits off with trailing stop level. So the entry to the getting rid of the first half made 1.53% plus whatever I made on the profit targets. And then we just headed all the way back down. And you can see this is my emergency stop here. Emergency stop is going to be 2 ATRs below my entry point. This was the emergency stop that I figured out before I entered the trade so that I knew how many shares to buy. But again, 520 crossover, moved up, took profits, got to trailing stop level, had a close below the previous day's low, took off half, more profits here, and then it was just a down move. And what happened here? It got down to my emergency stop. Also had the 520 cross under. That is my end of day. My end of day stop was a 5 crossing under the 20. That just happened to coincide with the emergency stop on this particular trade. I did not wait till the end of the day because I don't wait for end of day stops. I'm sorry, I don't wait for the end of day to come if I hit my emergency stop, which I did. But again, only on probably from original standpoint of about 35%, 35 to 40% of my original shares. So it turned out pretty good, actually. All in all, the trade was a slight loser. But look, if I would have just held this mechanically, it would have been a 2.44% loss, but it was not. It was closer to break even because of the taking the profits, because of the trailing stop getting out of half here. Very important. And so this is a good example of why I play offense, play defense, have trailing stop levels, have end of day stop levels, have emergency stops, and position size for volatility. But the second half, the remaining half, on the same day, we had a 520 crossover, which would have got me out for an end of day trade. And also, more importantly, just hit my emergency stop on the second half. So I did get out for a 2.44% loss on gold here. UMP. All right, here we go. I did buy UMP on the 27th of April. What were my entry signals? Well, my entry signals were a close under, close over the 200-day moving average. That's the main entry signal that I keyed off of. But we also had a confluence of signals. We had a V1 entry trigger. Here's bar 1, bar 2, the day I bought it, went under bar 1, closed back above, held the 200-day moving average at the end of the day, and that was my entry. And that is why I took the entry. But like everything else, I position size using the 2 ATR, placed my emergency stop. Where's my end of day stop? Yep, close below the 200-day moving average. What's the orange line? 1.5 ATRs above is where I go into trailing stop mode. So I bought here at 237.07. Next day moved up. Can't remember if I hit a profit target or not. I believe that I did. Yes, I did. I do believe that I did, and took 10% off, right, at profitable levels. And then my end of day stop, any close below the 200-day moving average. And going into Friday in the afternoon, it was holding at the 200, just right there. It was really holding the support at the 200. And then at the end of the day, with that end of day sell-off we had, it closed below, so I had to get out. So a loss of 1.28%. All in all, with these particular swing trades, pretty happy actually how they held up in the face of what the market did. So, taking small losses on swing trades is fine. The profitable math equation for making money long-term in the stock market is you have to have big wins, you have to have small wins, you can have break-even trades, you can have small losses. You just can't have large losses. That's what messes up the calculus of it all. So a 1.28% loss, not too shabby, not going to hurt the account. So it's important to get out when you're supposed to get out. All right, that's UMP. All right, last trade, I also got out of Love, which is Southwest Airlines. And let's see, I don't know what this is here. Okay, as I mentioned, I trade multiple time frames, daily, weekly, monthly, intraday. This was a monthly trade that I took on Southwest Airlines. Why did I take it? Well, here we have a V2, bar 1, bar 2, bar 3, bar 2 washes out or goes below bar 1's low, Then bar 3 closes above bar 1's close. It also rejected the 100-day moving average, got in here 44.74. Next month, my end of day stop was closed below halfway of the washout bar. And then of course I have emergency stop down here, right? Always have an end of day stop, always have a emergency stop. So I entered here January 1st. So I've been in this trade for a while, 44.74. Next month moved up, hit some profit targets. My close below, halfway below the washout low here. It went below but closed above, went below but closed above, went below but closed above. And this month too also tested that level 42, went below, closed above. Hit some profit targets here on Southwest Airlines intraday. So I did take off 20% of the trade at profitable levels. And then, but why did I get out here? I didn't close below. I got out because of earnings. Again, I don't hold through earnings, even if it's a monthly trade, weekly trade, doesn't matter. I'm just not going to hold through earnings. So I did get out prior to earnings and made had a gain of 2.8% on this particular trade. So the only open trades I have right now, I didn't take any trades on Friday. Only open trades I have now are Pfizer, still holding the 200-day moving average, and TLT, still holding the 30 RSI level. Okay, so what do we have here? 607. All right. So listen, before we start taking a look at the symbols that I'm looking at next week and what levels and how I would play them, I want to talk about trader psychology. I posted this. This is, I guess, psychology, not specifically trader psychology, but I posted this on Twitter and had so many likes and so many retweets. I was like, wow, people really like this. This must be resonating. This is from John Greenleaf Whittier. Back in he was born in 1807. I guess he died here 1892. Pretty long life there for John. But I'm going to read this, and this was back in the 1800s, but as we read it, I'm sure you'll relate to it as well. So people back then must have felt exactly the same way. And I think it's an appropriate time with what the market's done. I think unless you've been short, people's emotions and their morale's a little low. So let's read this. Hopefully it will help. Don't quit. When things go wrong, as they sometimes will, when the road you're struggling seems all uphill, when the funds are low and the debts are high, and you want to smile, but you have to sigh. When care is pressing you down a bit, rest if you must, but don't you quit. Isn't that a great line? Isn't that a great line? Rest if you must, but don't you quit. Life is strange with its twists and turns, as every one of us sometimes learns, and many a failure comes about when he might have won had he stuck it out, or she, right? When he or she might have won, but had stuck it out. It's an important line. You might have won if you'd stuck it out. Don't give up though the pace seems slow. You may succeed with another blow. Success is failure turned inside out, the silver tint of clouds of doubt, and you never can tell just how close you are. It may be near when it seems far. So stick to the fight when you're hardest hit. It's when things seem worst that you must not quit. For all the sad words of tongue or pen, the saddest are these: it might have been. Poof. Man, that is good stuff, everybody. Does that resonate with anyone with trading lately, or maybe in your life? It sure does with mine. I can tell you that. I love that. I love that line. Rest if you must, but don't you quit. It's when things seem worse that you must not quit. For all the sad words of tongue or pen, the saddest are these: it might have been. Wow. John Greenleaf Whittier. I don't know who it is, but back in the 1800s, it seems like he wrote it for contemporary modern day, doesn't it? And specifically for last week for traders. So anyway, I hope this is helpful. Rest if you must, but don't you quit. I think that's my favorite line in the whole thing. All right. I talked about a quick poem from Frank. This is Frank over at Franco DDI over on Twitter. Great guy. He was in my podcast when I had the live podcast for all those years, and he would post a poem every day. Just love these. Let's see what Frank has to say today. Selling pressure can burn a hole, filling your stocking with a lump of coal. Traders adjust, but they stick to their goal. They know losses that mount always take their toll. Boy, this is so true, this last part. They know losses that mount take their toll. Losses take a toll on traders. Financially, obviously, but mentally too. Mentally too. It affects your confidence in trading. That's another reason not to let those losses get big. Take those small little losses. They sting a little bit, but they're not fatal. But if you have big hits, it can be fatal, and you can blow up your account and you can lose all your confidence. So one more time, this is great, Frank. Selling pressure can burn a hole, filling your stoppings with a lump of coal. Traders adjust, but stick to their goal. They know losses that mount always take their tolls. Yes, they take their toll. So position size correctly, get out quickly when you're wrong. That first loss is the easiest loss. Okay, one more graphic I'm going to share with you, and then we're going to get over, take a look through the watch list. This is from my friend Thomas Payne at Trader T Payne over on Twitter. Great channel. I think Thomas is a great guy and a great trader. He was a scientist and he switched careers to become a trader, but he really brought the scientific method into trading, which I really like. And I haven't seen a post from Thomas for a while. Saw this today and I was like, wow, this really does make sense, because it is something that I look at with my trading. But follow Thomas at Trader T Payne over on Twitter. While market lows are being tested, only 14% of NASDAQ stocks are currently above their 200-day moving averages. You know, I always look at the 200-day moving average. It's an important indicator. A lot of buyers come in at the 200, the 250, the 300-day moving averages. But the first is the 200. The first is the first major line of defense. And what Thomas is saying here, only 14% of the stocks in the market are above their 200-day moving average. Why is that important? The stocks that hold up the best in drawdowns are the ones that tend to go up most when the market eventually recovers. So now is the time to find stocks holding up with relative strength to take advantage of the next rally. You know, if I have two identical stocks, maybe they both have two combinations indicators lining up. Maybe they have a V1, let's just say 3. They have an under 30 over, let's say 4. Under 30, over 30, under 200, over 200, V1, and let's say it rejected the negative third ATR channel, right? Those are 4 beautiful entry signals. Well, let's say Apple has those, and let's say, I don't know, Philip Morris has the same setup, but the market was down on that day, and one of those stocks was up and the other one was down. Which one am I going to pick? I'm going to pick the one that was up because it's showing better relative strength, and that's what Thomas is pointing out here. Now is the time to find stocks holding up with relative strength to take advantage of the next rally. Nobody knows when the next rally will start. Always stay ready. It's a good point, Thomas. We don't know when it's going to start. Look, we're getting down to some pretty significant levels. We've taken out lows last week. There's a lot of fear in the market. Everyone is bearish. Generally, those are good signs, right? It's counterintuitive, but they're good signs. It doesn't mean we have to rally here, but we might. So always stay ready. So really what Thomas is saying here, there's only 14% of stocks that are above their 200-day moving average. Right now, with this huge market sell-off, is the time to look for the strongest stocks. And when we go through the watch list today, I'll point those out because I always look for relative strength, the stocks that are holding up the best. And I'll show you some examples, all right? All right, let me get a drink of water, and then we'll head over to the charts. All right, here we go. Next week, what I am going to be interested in is Apple. Apple had earnings. Initially, the stock went up and then it reversed hard. just give me an example. Here's Apple. This was a great trade I had on Apple. Back here, we had a close under, close over the 200-day moving average. Also had a V2. Day 1, 2, 3, 2 goes below day 1, 3 closes above day 1's close. I bought that trade there, I don't know, about 155, and look at the move that I had up. It was beautiful. Moved, continued to take profits, continued to take profits. In this particular case, we got to my trailing stop level, but we never had a close below the previous day's low. We got above 65 RSI, then had a close below the 5 EMA. That's when I got out. So I got in. And of course, I scaled out along the way as well. But about 155 was the entry point. The exit point was about 174. And I got out with a close below the 5 EMA. Was that the right time to get out? Well, it did rally one more day. But yes, of course, clearly it was. And again, these are the things that I teach in my one-on-one course, the trailing stop methodologies. It's super easy to get into stuff. You can get out quickly, but what do you do to the upside? That's where I spent most of my time and most of my study, is how to get out of stocks to the upside, right? But we have right now in current market, we have a close below the 200-day moving average. Look, a couple days ago, it closed below the 200, then closed above. Did I buy that? No, I didn't. Why didn't I buy it? Because earnings were coming out. Had I bought it here, look where I'd be right now. But earnings are past. And so what I'm looking for next week is either a close back over the 200-day moving average. If we had higher, I would buy that, especially with a stock like Apple. This looks like it's come down quite a bit. And it has. But look, it's barely under the 200. It's above the 250. It's above the 300. Most of the stocks that we're going to look at today are far below the 200, the 250, the 300. So that's what I'm talking about, relative strength. Relatively speaking, Apple has been much stronger for the rest of the market. I love Apple for swing trades. And so either a close back above the 200 is where I'd be interested next week for Apple. If we head lower, I would key off of the 250. If that one holds, great. If it doesn't hold, I'll get out for a small loss, hopefully, and continue down to the 300-day moving average. So if it heads back down, I'll try to key off the 250. Head back down even lower, I'll key off the 300. If it goes up and closes above the 200, then I will get in there as well. Again, just like this previous trade back here, you can see as soon as it tested below the 200 and came back above, we had a big move. Is it going to happen this time? I don't know. I really don't. All bets are off in this market, but all we can do is key off of our level. So again, one of my favorite trades for next week that I will be looking to take, a close above the 200. I will buy it. If it closes back under, I'll get out. If it heads back down and rejects the 250, I'll keep it there. If it rejects that, I'll get out. If it intraday rejects the 300-day moving average, I'll get in, use that as my level. It's all about levels, everyone. It's about looking for levels that the world's looking at. And I promise you, the world is looking at the 200, the 250, and the 300 on Apple. So one of my favorite ones for next week. We'll see what happens. And the relative strength being barely under the 200-day moving average. AGQ. Well, okay, so AGQ is far below the 300, it's far below the 250, it's far below the 200 and the 100. I mean, this move down is historic, really. I mean, it's big. But I've seen these moves on silver before. This is AGQ. This is 2 times leverage, by the way. We're at a 2884 RSI right now. If silver closed back above the 30 RSI, that would be my signal. I'm not keying off the 300. I'm not keying off the 250. I'm not keying off the 200. We are well below those, right? This really makes the point of Apple. Look, Apple just barely below the 200, but holding the 250 and the 300. The relative strength on Apple is strong. AGQ, not strong, but we are below a level. So next week, if we close above the 30 RSI, that will be my signal. Unless it closes like at 38, 39, 40, that's too big of a move. But if it closes anywhere from 30 to maybe 35 RSI, that's where I would take the trade. You have to be careful if you have under 30, over 30s, not to chase them. And I consider anything over about 35 chasing, because ultimately a 50 RSI above that is going to be a strong resistance level. And for risk to reward, I want at least 2 to 1, right? If I buy at 40 RSI, then 40 to 50, that's 10 points. But my stop is going to be 30, so 40 to 30. So I have one 10 points to the upside, 10 points to the downside, that's not a 2-to-1. So 35 gives me 5 points to the downside, gives me 15 points up to 50. That is a 2-to-1. So about 35 is about my maximum that I'm going to take. So I'm not going to just take any move back over the 30 RSI. But if we have a nice gentle close above 30 RSI that gives me a good risk reward, I will take AGQ. Amazon. Well, if you bought Amazon and you bet on earnings, you had a quick 14% loss. And I'm not making fun of anyone. If anyone did that, I really feel for you. I promise you I do. But it is a good teaching moment of not to bet on earnings. And holding through earnings, you're essentially betting on earnings. And it moved down 14.05%. And it also lost the 30 RSI. We're at 29.34. So next week, if we have a nice gentle close above the 30 RSI, I will look to buy Amazon, depending if I have a better setup. If Monday, Amazon closes above 30 RSI and that's all it does, but Apple closes above the 200, of course I would pick Apple. It's way stronger and it had good earnings. So, and the relative strength is stronger. But if Apple doesn't, if it goes down and Amazon closes back above the 30 RSI, I might consider buying that. Berkshire Hathaway. Well, talk about relative strength, everyone. 14% of stocks on the NASDAQ are under their, only 14% of stocks above in the NASDAQ are above their 200-day moving average. Well, look at Berkshire Hathaway. It is well above the 200-day moving average. Yes, it came down with the rest of the market, but the relative strength of Berkshire is super duper strong. We're at a 31 RSI. One of my favorite setups is when you have a combination of an under 30 over 30 and an under 100 over 100. We don't talk about the 100-day moving average much. It's usually the 200 or the 250, but it's important in this case if you have a confluence of an under 30 over 30 and an under 100 over 100. I learned this from my good friend Steve Burns. Follow him at S. Joseph Burns over on Twitter. It's a great guy, great author. I studied one-on-one with Steve for a significant number of times. Really learned a lot from him. Just wanted to say thank you to Steve. But that was one of his favorite indicators, was an under 30 over 30. At the same time, you have an under 100 over 100. And we're right about there. Right now. Let's see, did this actually go under 30 RSI? I have a little tool here on Trade Navigator that I can measure that. No, got to 30.34. Boy, I'll tell you what, that 30 RSI really does command support and respect. And so I really like Berkshire Hathaway for next week, but I would have to go under 30, over 30, depending what happens Monday morning. It might do that and reverse back up. So I really do like Berkshire because of the 30 RSI 100 confluence and also the relative strength of Berkshire. All right, here is DIA. I did put in all of the indexes here just so that we could go over these a little bit. I don't really see anything right that's close for the Dow, but I did want to look at it as it is a major index. We're at 3811. So we're not really close to the 30 RSI. We're not really close to the negative third ATR channel. Let's just take a look at some multiple time frames on the Dow. Well, on the monthly, the Dow has come back into the value zone and it's holding. It's the strongest index by far. So let's keep that in mind. On the weekly, we've lost the value zone, but if the Dow goes down, looking for a weekly trade, I would love to buy Dow with an under 30 over 30 and a close above the 100 on the weekly. But don't know if we're going to get there. But still pretty weak on the Dow here. In order for me to get interested, if I was buying the index like the Dow, it would have to go under 30 over 30. That would be the most likely scenario for me to buy the Dow for next week. All right, Google. Well, we already talked about Google. I did have the slight loss on Google. I got out before earnings. Right now, we're at 32.75. If Google next week were to go under 30, back over 30 on a company like Google, you don't get a lot of chances to buy a company like Google under 30. Most of the time, most of the year, it is well above but it may get there. So next week, if Google goes under 30, over 30, might possibly be my entry point there. Goldman Sachs. Well, Goldman Sachs well below the 200, the 300. You can see these are up here, 250, well below their very, very weak 35.64 RSI. This definitely could go under 30, over 30 for next week, so I'll be keeping my eye on Goldman Sachs. IBB, another under 30, over 30 candidate. Of course, the 200, the 250, the 300, way up here, not even considering that, but looking for a bounce play, and under 30, over 30 might be possible next week on IBB. Russell 2000, another index of the mid caps. Did want to include all of the indexes on here. You know, it's interesting. We had the February lows on IWM, and we bounced there. That was the day of the invasion. We bounced up nice, and then this huge move down. We rejected the previous low Thursday when we had the big move up, and now we're boom back down to the new lows, and we're at 34.34 RSI. We are at the negative third ATR channel. I know 92% of prices generally stop going down there, go up, but it doesn't mean they have to. I said 92, not 100%. 8% of the time, it can just keep moving down, and that might be one of the positions that we're in right now. But for IWM next week, looking for an under 30, over 30. And under 30, over 30s are actually even stronger on indexes than they are on individual stocks. Individual stocks can tend to go to lower RSI levels. Under the 30 RSI, they can go to 80 RSI levels to the upside instead of the 70 RSI, but indexes tend to really respect the 30 RSI and the 70 RSI. Not always, not perfectly, of course, but that's why I put these here, because we are getting close to a 30 RSI on the actual indexes. Joe, you know, all these years that I saw Joe, I never made the connection. I don't Joe, like a cup of Joe. My trading partner Ava pointed that out to me, and she goes, you know, Joe, which is another word for coffee. And so I thought that was pretty clever. J-O for the symbol for coffee. It's kind of like when I was in the chewing gum business in my 20s, my company went public, and we made chewing gum. What was the stock symbol? Gum. G-U-M-M. Kind of fun, right? So next week, it did respect the 200-day moving average, bounce, move back down. So next week, if we get a nice rejection of the 200-day moving average, I may be interested there. Or if it heads back down, I would key off of the 250. McDonald's, talk about relative strength. Holy smokes. We are still above the 200-day moving average, which is pretty impressive compared to what the market's done here. So next week, if I get a nice bounce at the 200-day moving average, that would be my entry. When I play the 200s, when I play the 250s, when I play the 300s, I look for either three things. Just a simple close under the 200 or 250 or 300 and then back over, or an intraday rejection where the price comes down during the day, closes back above. That's an intraday rejection, or a bounce where it just comes down, literally touches it and bounces. I consider them all the same. So a close under, close back over, an intraday rejection of the 200, or a bounce on McDonald's, I would be interested in that. One, because it backtests fine with the 200-day moving average, but the other thing too is the relative strength. And like I just mentioned, look for things that have relative strength. That's probably your best bet. At least that's how I look at it. Pfizer, okay, well, I'm already in Pfizer. It's still holding the 200-day moving average, but if I were not in Pfizer and next week we had another intraday rejection of the 200, I would consider taking it. Remember though, earnings are coming up on the 5th, so I would need to get out of that. You'd have to check and see if earnings are in the morning or the afternoon and act accordingly. But another intraday rejection of the 200 would be great. If earnings come out and the stock moves down next week, well, then I'll key off of the 200-day movement, the 250 or the 300. Or if it's back above the 200 and it's not too stretchy or it's not too chasey, hasn't moved up too much, in other words, I would take another look at it there. But for right now, still in this trade. But if Monday we had a rejection of the 200-day moving average and I wasn't in the trade, I would probably take it again. Qs, well, talk about a move down. Look at this. We got up to the 200-day moving average and the third ATR and close to the 70 RSI. And what happened? It failed. Boy, oh boy, did it fail spectacularly. Important here on the Qs. Look, we undercut March lows here. We came back up on Thursday, and now we are back down. So we are making new lows from March's lows. Now, the good news is a lot of times price is drawn to these levels for liquidity's sake. And oftentimes, if you can get down to a major previous low and reject it, then you may have a nice explosion upwards. Maybe it could come down. I'm not saying that's happening, but when you test major levels, a lot of times you can expect big moves either up or down from that level. So next week for me, 30 RSI, under 30, over 30 looks like about the only plausible entry for Qs. But I really like under 30, over 30s, especially on indexes. We're going to be hearing from the Fed on Wednesday as well. That could make the market go down. We could have a huge rally. You never know. But what I'm looking for on the Qs is an under 30, over 30 next week. SPY. Well, same with SPY as some of the other indexes. We have undercut the lows of February. We have not undercut the lows of February. So SPY is much stronger. Qs undercut it. IWM undercut it. Dow stayed above DIA, and S&P has not taken out the low. So you can see the NASDAQ, the growth stocks are the ones that are being hit because of the fear of higher interest rates and inflation and so forth and so on. SPY right now, 35.42 RSI. If we go under 30, over 30, that is where I will be interested in SPY for a deep dip buy. TLT, again, another one that I'm already in, but next I got in with a higher low, under 30, over 30. If it closes under 30, of course I have to get out. But if it then closed back above 30, I would take another shot at buying TLT with a good risk to reward ratio of the 30 RSI. Hopefully it just heads up. It would be good for the market as well. As bond prices go down, interest rates go up. So these are bond prices going down, 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 down. What does that do to interest rates? Up, 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 up. So you really want to look at bonds. Getting bonds to go up would be fantastic for the market. It would really be good for the market. So I'm hoping these 30 RSIs hold so that the bonds can move up, which would be a better thing for the market. Tesla. Well, Tesla is being very, very strong. It is barely under the 200-day, but it has been relatively strong compared to the rest. And so Apple and Tesla have both been relatively strong compared to the rest of the market. So what's going to get me interested in Tesla next week? Either a close above the 200-day moving average, which is the black line, an intraday rejection of the 250 if we head lower, that's the purple line, or an intraday rejection of the 300 as well. I did put this up. I want to back test this for you. This is etfreplay.com, and when I look to buy bounces off the 200, the 250, the 300. I always want to check in with ETF Replay to see, hey, does a rejection of the 200 actually backtest well? Well, let's try it out. Here's Tesla, 200-day moving average. Basically, this is saying if it closes under and then back over the 200-day moving average, what would those results have been? Staying in above the 200, going to cash below. Well, did it backtest well? It did. 1,566.8%, well below buy and hold of 16,404, well below, but still it shows that there is an edge off of the 200-day moving average of 1,566. Let's just go ahead and switch this to the 250 because the 250 could also come in play next week. And let's see, does that one backtest well? Yes, backtest better, 2,098. Let's check the 300-day moving average and see how that one backtests. 3,000. So really, ultimately, I would prefer buying off of the 250 because it does have a better backtest record, or ideally off of the 300 because that has a good backtest record. And if we get down to the 300-day moving average, we'll be, depending on how fast the move is, we'll have a confluence of signals of an intraday rejection of the 300, hypothetically and hopefully, and also an under 30, over 30. Remember the combinations, right? And financials were at 29.36. So if we had a nice move back up above the 30 RSI, then I would consider buying these. Now, if we have a big day up on Monday, for example, maybe all of these are going to trigger for me. Am I going to buy them all? No. I usually only buy one position per day, the best one out of the group. So don't expect if the market goes back up that I'm going to be in all these trades. One trade per day is all I take. I like to stagger my entries. It just helps with a lot of different things. It makes, if things head up, then I can add and keep adding. And the positions that I have previously are already in the money, so I can add more. But if I add something and it fails, then I go back to no position. If I add something fail, go back to no position. But if I add 5 positions and then they fail, then I really get hit. So that's just a personal thing from me that makes me feel better about trading. And over the 25 years that I've traded, I have found that buying one position per day works the best for me. So real quick, Apple. Looking for a close, if we head back up, looking for a close over the 200 or rejection of the 250 to the downside, 300 to the downside. AGQ, looking for a close back above 30. Amazon, looking for a close back above 30. Berkshire Hathaway, looking for an under 30, over 30, and close back over the 100. Dow Jones Industrial, we'd be looking for under 30, over 30 on the daily. Google, looking for an under 30, over 30 on the daily. Goldman Sachs, under 30, over 30 on the daily. IBB, under 30, over 30. Russell, under 30, over 30. JO, which is Joe, rejection of the 200-day moving average. McDonald's, rejection of the 200-day moving average. Pfizer, close under, close over the 200, or rejection of the 200-day moving average, as long as it's before and I get out for earnings, or if it happens after earnings, same thing. Qs, under 30, over 30. SPY, under 30, over 30. Bonds, under 30, over 30. Tesla, close back over the 200-day moving average, or a rejection of the 250 or the 300 to the downside. And then XLF, under 30, over 30. So, all right. So I mentioned at the beginning of the show that I do teach private one-on-one lessons in the evening time via Skype. I love to teach. I've taught people from all over the world. I've been trading for 25 years. I like nothing more than to teach a new student the proper trading techniques that I use, the 5 different trading techniques that I use. I've had so many, emails of thanks and reviews from my private lessons. And if you want to really learn step by step how to do everything that I do and how I trade and how I take a look and position size and trailing stops and all this kind of stuff and the 5 different approaches that I use, send me an email. Email is in the link of this YouTube video, and reach out and say, hey, Greg, I'm potentially interested in taking your course. I will reply and say, great, thank you for saying hi. Let's set up a Skype call. The Skype call is free. It's not a sales call, everyone. I can promise you that. All I want to do is meet my prospective student, talk to them, talk about their trading challenges, their goals, and then answer any specific questions they have about the course. And then after that, after we're done with the Skype call, get to know each other a little bit, and you ask your questions, then it's on you. I will not contact you if you decide after the Skype call, after speaking to me, that it's something that you want to do, that it's going to help you develop this skill. Just email me back after we're done with the Skype call and say, Greg, I want to get going. I'll say, great, let's get it scheduled. And I promise you, you're going to learn a lot. I promise you, you're going to be happy that you took the course. The course is $1,750. Sounds like a lot, but it is 15 hours of one-on-one instruction. And I think the best way to learn anything whether it's guitar or violin or trading, anything is one-on-one with your instructor, and that's why I provide a format like this. Number two, I do have an online video course available on udemy.com. It's a great course. I've had so much good feedback, so many good reviews from around the world, and if you're just starting to trade, I can't think of a better course to take. It's affordable. It's only 12 or 15 bucks on Udemy. I mean, that's it. And you get tons of content. You get 9.5 hours of video. You get 15 study guides. You get 26 videos, and I teach you step by step how to trade the deep dip buy stock trading strategy. And by the way, this is the market that we're in right now. You can't do better for the price. I get emails all the time saying, I can't believe the information and what I've learned in here for this low price. So if you're interested in taking that online course, not as good as the one-on-one course, but really still good, please take a look at the description of this YouTube video. The link's in there. And then lastly, if you could hit the thumbs up button before you head out, I would really appreciate it. It helps to build the channel. It helps YouTube know by the thumbs up that there's some valuable content here and that the viewers liked it. And so happy to make these videos. Hope you enjoy them. Hope they're helpful for you. But all I ask in return is if you could hit the thumbs up button. So I think that's it for today, everyone. It has been a wild week last week. I don't know what this week's going to bring, but you know, if you're down in the dumps a little bit about your trading, I just want to remind you again, the market goes up, the market goes down, but we have to wait for our signals, right? That's why today I talked a lot about these 200-day moving averages and mainly the under 30, over 30 RSI. So be careful. Try to go out and do something nice for someone today. Just a smile, wave, help, hold the door open, just something, you know, if somebody does something nice for you, you know you always appreciate it, and other people would appreciate it if you do it for them as well. I'm a big animal lover. If you could also, if I could be so bold to ask, if you could go out, try to do something nice for an animal today as well, they appreciate it. I was raised with a lot of animals, and they do appreciate acts of kindness. So if I could just ask one nice thing for another human being today, one nice thing for an animal, and I promise you it's good karma. It's going to come back to you as well. And so please keep that in mind. So enjoy the rest of your weekend. Be good, be safe, drive safe, try to get some exercise, maybe do a little meditating, a little presence work, study your charts. But more importantly, be careful next week. Wait for the proper signals. If you have any questions or comments, just leave them in the comment section below. Do my best to get back to them. But again, appreciate you being here. Stay safe next week and enjoy the rest of your weekend. And on the way out here, I have to run the U.S. legal disclaimer. Thank you so much, everyone. Take care. Bye-bye. U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.